Unit trusts pool money from multiple investors to create a diversified portfolio managed by professionals. This collective investment approach offers accessibility and risk management, making it an attractive option for both individual and institutional investors. Understanding the structure and benefits of unit trusts is crucial for making informed investment decisions.
A unit trust is a collective investment scheme allowing investors to pool resources into a diversified portfolio. Managed by professionals, it offers access to a range of assets, reducing individual risk. Investors purchase units, representing their share in the portfolio, benefiting from professional management and diversification.
Unit trusts are collective investments structured under a trust deed, ensuring legal protection for investors. Investors purchase units that represent shares in a professionally managed, diversified portfolio. Unlike other investment vehicles, profits are directly distributed to investors, offering regular income streams rather than being reinvested. In 1931, M&G, under Ian Fairbairn's leadership, launched the United Kingdom's first unit trust. This innovative investment vehicle mirrored the resilience of United States mutual funds post-1929 crash. The first British fixed trust held 24 top company shares for 20 years, laying the groundwork for modern collective investment strategies. The birth of unit trusts marked a pivotal shift in investment, democratizing access to professional fund management. Emerging from the 1929 crash, this concept allowed individuals to pool resources, gaining diversified exposure to markets previously reserved for the wealthy. This innovation laid the groundwork for modern investment strategies, transforming how people engage with financial markets.
Unit trusts operate under a trust deed, outlining investment goals, management duties, and investor rights. Independent trustees own assets, ensuring fund managers prioritize investors' interests. Professional managers actively oversee diversified portfolios, adhering to specific investment objectives and risk parameters. Unit trusts are unincorporated entities operating under trust deeds, emphasizing fiduciary relationships. In contrast, mutual funds are corporate entities where shareholders hold equity stakes. Unit trusts use dual pricing with bid-offer spreads, creating profit margins for fund management, while mutual funds rely on a single pricing structure based on net asset value calculations.
Unit trusts are structured as unincorporated entities governed by trust deeds, ensuring fiduciary responsibility. Management involves a fund manager making investment decisions, a trustee safeguarding investor interests, and a registrar handling administrative tasks. This structure ensures efficient operation and compliance with regulatory standards, providing a robust framework for managing investor funds. The fund manager selects and manages investments, making daily trading decisions based on market analysis. The trustee acts as an independent fiduciary, ensuring compliance and protecting investors' interests. The registrar serves as the administrative link, managing unit transactions and maintaining investor records. Unit trusts are open-ended, allowing dynamic fund size changes. New units are created with investor contributions, while redemptions reduce outstanding units. Daily net asset value pricing determines unit value by dividing the net asset value by total units. The bid-offer spread, the price difference between buying and selling, generates operational profit for fund management. Unit trusts offer diversified investment opportunities across various asset classes. They include equity securities from global markets, fixed income through corporate bonds and government gilts, real assets like property and infrastructure, and cash equivalents such as money market instruments. This diversification aims to optimize risk-adjusted returns for investors. A typical unit trust portfolio exemplifies professional diversification, spanning various asset classes, sectors, and geographic regions. This strategic allocation aims to optimize risk-adjusted returns, balancing potential gains with manageable risks. By leveraging expert management, investors can access a well-rounded portfolio designed to meet diverse financial goals. Unit Investment Trusts, UITS, are a unique investment vehicle. They offer a fixed portfolio of securities, providing investors with a clear passive management strategy. Unlike other trusts, UITS have a predetermined termination date, ensuring a defined investment timeline and exit strategy, which can be appealing for those seeking structured investment opportunities. Unit Investment Trusts, UITS, feature a fixed portfolio, purchasing a set of securities at inception with minimal changes. They have a predetermined termination date, dissolving and distributing proceeds upon maturity. This passive management approach offers investors a clear investment timeline and exit strategy, contrasting with actively managed alternatives. Unit investment trusts are passively managed, featuring fixed portfolios and predetermined termination dates, minimizing ongoing fees. In contrast, unit trusts are actively managed, with dynamic portfolio optimization and an open-ended structure, incurring regular management fees. This flexibility allows adaptation to market conditions, offering a more hands-on investment approach. Unit investment trusts offer a buy-and-hold strategy with minimal adjustments, providing stability but limited flexibility. In contrast, unit trusts offer dynamic management, adapting to market changes, but incur regular fees. Understanding these differences helps investors align their choices with financial goals, balancing stability with adaptability. Unit trusts offer professional expertise, granting access to skilled fund managers with deep market insights. They provide risk diversification by spreading investments across various asset classes and regions, minimizing individual security risks. Additionally, they offer investment flexibility, allowing investors to adjust their contributions based on personal financial needs and market conditions. Unit trusts have drawbacks, including reliance on fund manager expertise, which can affect returns if mismanaged. Additionally, fees like annual management charges and bid-offer spreads can erode long-term growth. Despite diversification, market volatility poses risks, potentially leading to capital losses. Understanding these factors is crucial for informed investment decisions. Unit trusts generate returns through capital appreciation, where unit prices rise as the portfolio's value increases. Investors also benefit from income distributions, including dividends and interest. Additionally, the bid-offer spread provides operational revenue, supporting fund management and administration. Unit trusts generate profits through capital appreciation, where unit prices rise as the portfolio's value increases. Income distributions from dividends, interest, and realized capital gains offer steady returns. Additionally, bid-offer management creates operational revenue by leveraging the spread between buying and selling prices, supporting fund management and administration. Investors in unit trusts encounter taxable events such as dividends from equities, interest from bonds, and capital gains from asset sales. Tax treatment varies by jurisdiction, affecting domestic and international investments differently. Understanding these variations is crucial for optimizing tax efficiency and maximizing returns. Unit trusts have a global presence with diverse adoption patterns. In the United Kingdom, they are well regulated and widely used. Australia and New Zealand favor them for retirement savings. The Asia-Pacific region, including Singapore and Hong Kong, sees them as mutual fund alternatives. In Canada, income trusts adapt to local tax and regulatory frameworks. Unit trusts originated in the United Kingdom, supported by a robust regulatory framework and widespread adoption among investors. In Australia and New Zealand, they are integral to retirement and wealth management. The Asia-Pacific region sees growth in Singapore, Malaysia, and Hong Kong, while Canada adapts them as income trusts to fit local tax and regulatory landscapes. M&G's Blue Chip Fund began in 1931 with a fixed trust of 24 top company shares for 20 years. By the 1950s, it evolved into a flexible management approach, adapting to market changes. Today, it stands as a diversified fund, showcasing long-term growth and adaptability in the unit trust industry. When choosing unit trusts, assess your financial goals, time horizon, and risk tolerance. Evaluate the fund manager's track record and investment philosophy. Analyze the portfolio's composition, diversification, asset allocation, and fee structure to ensure alignment with your objectives. This comprehensive approach aids in making informed investment decisions. Define your financial goals, time horizon, and risk tolerance. Decide if you prioritize capital growth, income, or preservation. Evaluate fund managers by their track record and philosophy. Analyze portfolio composition, diversification, asset allocation, and fees to ensure alignment with your objectives. Units are bought at the current offer price, calculated daily based on net asset value through advisors, platforms, or fund managers. Minimum investments vary. Selling involves the bid price, with settlement in 3 to 5 days. Regular reviews ensure alignment with goals. Consult advisors to align investments with your financial situation and objectives. Professional guidance is crucial in navigating unit trust selection. Expert advisors help align investments with your financial goals and risk tolerance, ensuring a tailored approach. This personalized strategy maximizes potential returns while managing risks, providing a solid foundation for achieving long-term financial objectives. Unit trusts democratize investment access, offering professionally managed, diversified portfolios. Understanding their structure, fees, and risks empowers informed decisions, aligning with financial goals. Ideal for those seeking professional management and diversification, unit trusts provide a solid foundation for long-term wealth building and financial security.